Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the September 2023 First Friday webinar. Today's presentation is titled Canary in a Coal Mine. We will discuss the indicators telling us there is trouble to come, along with the conflicting current state of our U.S. economy, indicating all is well. The goal of our discussion today is to understand the risks inherent in our current investment environment relative to the probable returns available for those choosing to remain invested in an overvalued market environment. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be approximately 15 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is, what is the market missing? If you have already sent us your questions, we want to thank you. Your questions help us understand what topics are truly important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box, or write it down and raise your hand at the end of the prepared remarks by clicking on the icon at the bottom of your screen. We will do our best to come to you at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Welcome. I'm Stephen Abernathy, and this is the September First Friday discussion for our family office members. As always, I want to take a moment just to deeply thank you for setting aside the time needed to discuss some increasingly important topics which seem to have surfaced over the last 30 days. As our host mentioned, we're going to discuss what I believe is a perplexing topic. It's one of the first topics that comes up in the majority of conversations I have with both analysts and investors. Why are the vast majority of leading indicators telling us there's trouble ahead while the economy continues to grow? Employment is at very high levels, seldomly seen in U.S. history, which is exactly the opposite of what any investor would associate with a recession to come. And help wanted indicators tell us there are more than 5 job listings for every unemployed worker. On top of that, wages are growing by 4% a year, all of which tell us there's no recession in sight. So none of those data points point to a recession or even indicate there's one in our future. So here's how the chessboard is stacked. You have the 3 most reliable economic indicators in history, all telling investors a recession is on the horizon, and with it, the likelihood that earnings will decrease by at least 20%, which is a real problem for valuations in a very overvalued market, which we have today. We have rampant speculation. History tells us that a stock market at current levels is at risk for a 30 to 50% downward revaluation. And at the same time, the employment rate is at near record levels. Help wanted job postings are signaling increasing employment demand, and wage increases of 4% a year support and strengthen that story. So we are clearly not in a recession. In fact, we believe the data indicate inflation may be harder to control than the market believes, which is the exact opposite of a recession. So this to us means that higher rates for longer are the likely outcome, and this increases the probability of one or more categories of our economy breaking. However, at this time, I must tell you that the U.S. economy is growing, and inflation appears to be more of a concern than a recession. This truly is a tale of two cities, creating a level of uncertainty for every investor. So, over the course of the last 6 months, I've been reminding all families we serve to concentrate on the signals and shut out the noise because it's confusing and it will save you hours upon hours of time and maybe some lost sleep. As I've said so many times now, there are only three leading indicators intelligent investors need to follow. Each of them in their own right offers a very high probability of describing the economy to come. Each is backed by historical events, and more importantly, they're backed by logic. They just tell you what the Federal Reserve is trying to do to our economy. And over time, these activities, they make an imprint. It just makes fundamental sense. The fact that all three leading indicators are pointing in the direction of a recession has made me seem as if I'm a permanently bearish investor. And if you have that feeling, I want to take a moment and assure you that I hope, like every true analyst hopes, above all, to be a realist. And what this means is I try very hard to look at data on both sides of the argument, and I often concentrate on the data which is not widespread, which is conflicting with the data that seems to be most prevalent. And in this discussion, we're going to describe the positive aspects of our economy first and the negative aspects of our economy next. Then we'll take a look. I want to take a look and diagram the last recession that we had and why our future might look very similar to the recession that I think is coming. And lastly, we'll show you a couple of indicators most investors don't have access to, which will lead us, which tends to lead the leading indicators. And lastly, as always, we want to address a couple of questions if there are any, and then we want to talk about what the market is missing because it's very interesting this week as always. So the public believes we're in a strong bull market. The investing public is putting their money in an overvalued market, and many are doing it with leverage. That's a problem. Are these investors blinded by hubris and overconfidence, or is it just willful neglect? There's been so much money available that the investing public is taking the risk of overpaying for assets. And are they taking that for granted as if the Federal Reserve will automatically come to their rescue every time the market stumps its toe? The answer to that might be yes, but I don't think that's not the way you should count as an investor. You shouldn't count on that. So I don't want to pull an age card on anybody, but I've been doing this for over 40 years. And this type of careless negligence happens at the end of almost every bull market. And it happens repeatedly, and the public just doesn't remember. Okay, so let's start discussing the positives. And here are the facts and the data that I believe is sustaining the optimism which is factored into the pricing of the market today. First,
Stephen, really quickly, if you don't mind just sharing your screen so we can see your slides.
Okay, I thought we had. Let me figure that out. Okay. Marissa, tell me if that works.
Yeah, that's perfect. Thank you.
Okay. So first, this is a listing of all of the positives. Consumer confidence is among the most highly accurate indicators and is included. It's one of the 10 indicators in the leading economic indicator index. It's been improving recently. Yet at just over 72, it's still almost 32% below the normal level of 100. So the positive take on this would be that consumer confidence, which is incredibly reliable, is improving. The other side you could take is that it's at 72, it's 30% below the normal level of 100. Next, employment, as we just mentioned, is within a hair of record levels, and it's been there for nearly a year now. High employment typically means consumers are easily able to spend money, and they've found, and we've never had a recession with unemployment levels under 4%, which is where we are today, clearly and comfortably. Wages continue to increase at between 4 and 5% a year on average. This is another supporting reason that the consumer is likely to continue spending. One cautionary note: when wages are increasing at 4% plus per year, it's going to be very difficult for the US Federal Reserve to slow our economy to a 2% level or 2% inflation level without some portion of the economy falling apart. It's just incredibly difficult to do this. While the calculation is not exact, our analysis shows that the consumer saved over $2 trillion as a result of the stimulus packages and the pandemic. The best estimates we can find indicate that their spending so far in 2021, in 2022, and so far in 2023 will end in the last quarter of 2023 or the first quarter of 2024. Keep in mind that the consumer drives over 65% of our US GDP. And if the consumer runs out of money, our economy will run out of steam. Recent data from the Atlanta Fed indicates our US economy will grow by over 3% in the third and fourth quarters of 2023. That's not a recession. That's great. While it's true that a good portion of that growth is the result of 3 to 4% inflation, and maybe all of that growth is the 3 to 4% inflation, it's doubtful that a recession will take place during the next 3 to 6 months. As I mentioned earlier, overconfidence and speculation is almost everywhere. Today's market valuation is the most expensive valuation relative to the US Treasury market in over 20 years. So regardless of the US economy's pathway forward, investing in overvalued assets, it just never makes sense for anybody, for any of us. And participating in any type of investment scheme without humility or with overconfidence is almost always likely to lead to an undesirable outcome, as we would call it. And lastly, as we sort of said earlier in the as a contra indicator, unemployment is under 4%, which is a pretty difficult level to attain. As we said earlier, while there's been a recent slight uptick in unemployment, the US economy has never, ever entered a recession with unemployment under 4%. So as a quick summary, anyone can see that there are reasons for investors to believe that history will not repeat itself. There are reasons to believe the old saying, it's different this time. For the first time in history, it is possible for the US Federal Reserve to get inflation back to 2% or below without pushing our economy into a recession. Is it really possible that the Fed will finally achieve that goal? Only time will tell. However, let's take a look at the other side of the coin. And remember that each topic on the next few slides, it's different from the most reliable 3 leading indicators. And most of these indicators are highly relevant because they lead the leading indicators. First, inflation is still much higher than the target of 2%. This means either the Fed has to change its target inflation rate to 3% or more, or it must consider continuing to raise rates and or maintain rates at these high levels until inflation dissolves. I just want to make the note that higher rates or even rates continuing at these levels means the probability of a negative event continues to increase as time moves on. Just staying at these levels increases the probability of a negative event every day. With the amount of debt we have at the national level, at the company level or the corporate level, and at the consumer level, the leverage associated with these debt levels could create a much larger problem. And I know that I sound like someone who's constantly running and hiding under my desk. It's just not true. I just want to make sure that I'm bringing up the point or pointing out the fact that inflation is sticky. The Fed is going to stay higher, keep rates higher than longer for longer periods, and the levels of debt, the record levels of debt, could create a much larger problem. And if that problem starts, it's going to be very hard to change, to put the genie back in the bottle. The consumer data that I showed you in the positive portion that said the consumer data has been improving for the last 6 or 7 months in serial manner, there's another part of that. And when you inspect the data underlying the consumer confidence levels, you'll notice that while they have risen recently, the data still show that 70% of consumers are expecting a recession, and that over 80% of the CEOs running companies today are expecting a recession. So a slight look under the covers starts to reveal some, what I think is alarming data. US credit card balances are at record levels, which doesn't bode well for continued consumer spending as interest rates have increased on credit cards from 14% in 2021 to well over 20% today. So for the US economy, which depends on the consumer for over 65% of its spending, this is a very strong negative indicator. The US debt, let me rephrase that. The US is a debt-based economy. And what that means for our economy to thrive or even maintain its economic level is that we have to have access to banks lending money. If not, because our economy needs so much access to credit, we're going to be in a really difficult place. Banks have significantly slowed their lending, and the lending they are offering has very strict covenants, which many companies can't or won't meet. What that means is bank lending has fallen off a cliff. In essence, the combination of banks making loans much less available and fewer companies are actually seeking those loans show that growth in our economy is going to be challenged. Aside from the fact that the Fed has raised interest rates over 5% in the last year and a half and is likely to keep it there or go higher during the next 12 months. All of you have heard about this ad nauseum. Student loan repayments are going to start in October. This means that 1 out of every 5 households in the United States will have a new after-tax bill due each month. While we don't believe this alone is enough to throw us into a recession, it's not going to be the straw that breaks the camel's back. It is certainly a reasonable clink in our economy's armor. And over time, it will slow the US consumer's demand. Lastly, the US home market is responsible for over almost 35% of our US GDP. Home building and all of the associated industries which cater to it, from buying repair products at Home Depot to the workers eating at McDonald's. When this industry catches a cold, our economy becomes really sick. This is why so many people ignore many of the other indicators and they just watch the real estate industry in the United States. As you can imagine, the mortgage application index is a leading indicator for expectations about what is to come for the real estate market. And as you can see, that mortgage rates have now more than doubled over the last 15 months. It's becoming more and more difficult for citizens to find the wherewithal to buy a home. So from the data I can access, those are the positives and the negatives, aside from the 3 major leading economic indicators. I can certainly see how some investors strongly believe we'll either have no recession or a very mild recession. I can also see how parts of the economy are definitely and without a doubt slowing. The question which is most often asked is, what is the most significant disconnect between our economy and the capital markets? And the most likely answer is that our market is not factoring in the US Federal Reserve's quantitative tightening. Both interest rate hikes and actually withdrawing money from our economy they're both restrictive. And they are going to force our economy to slow or stop, or they have it at least in every case since World War II in 1945. It's likely to mutate into a period of negative growth that we will, in hindsight, call a recession. So let's take a look at how this happened during, this is the reason I was leading up to, let's take a look at what happened during the last recession on a quick month-by-month basis. Here, this is the monthly GDP numbers leading up to the great financial crisis in 2008. I used this recession because it was the most recent and because it was a recession where the villain was debt and leverage, similar to the problem or to the probable villain in the recession we believe we'll enter at some point during 2024. So the color codes are meant to be helpful. I hope they aren't distracting. The light blue colors are the monthly GDP numbers leading up to this colossal recession, where the stock market was down well over 40%. But as you can see, in June, July, and August, nothing was even on the lookout. The light blue colors, as I said, they were the numbers that were leading up to the recession. And as you can see, the economy was growing at a reasonable rate well into more than halfway through 2007. For the next several months, the economy struggled, and this is outlined in yellow for you. Then the U.S. economy started to crack. It started slowly at first, posting fractionally negative numbers, and then our economy started collapsing. And this was all taking place despite the Federal Reserve's lowering interest rates and showering our economy with money, free money. The recession truly jammed or endangered our U.S. and global financial system. And we're not just saying this is going to happen over the next 6 to 9 months, and we pray it doesn't. However, our U.S. debt in the United States in 2007 was just a small fraction of our debt today, which does not, it sets the stage for a much wider variance of outcomes. So what I mean is that leverage makes positive outcomes greater, and leverage makes negative outcomes a potential disaster, as you can see from the month by month development of our last recession. You'll see some months in there that are in the high single digits, and this was a frightening time. So let me stop right here real quickly and go to Marissa for questions if there are any. Marissa?
Yes, Stephen, we only have one at this time. Here it is. So they said, over the last few sessions and in our conversations, you have mentioned the amount of leverage in the system, and that at some point, companies which have been losing money will have to declare bankruptcy. Where is this cycle? We have not heard much about it in the public media.
Okay, well, it just so happens this is a great question, and whomever asked it, I want to thank you, because it allows us to go. I was going to roundabout way get there anyway. It goes directly to our favorite portion of the First Friday webinar, which is what's the market missing. This is what I think the market is missing. It is the bankruptcy cycle. So let's go here. So what's the market missing? The market is missing growth. What do I mean by that? How would I say this? The next 3 to 5 years, the market is guessing or is expecting growth of almost 10% a year based on its current earnings multiple. So to support a 20 times earnings for a company, so a company that earns $1 is selling for $20 per share. To support that kind of evaluation, you need to be growing at well over 9, almost 10% a year to make that justifiable. Otherwise, the market multiple needs to come down. And as we've gone over this in each of the last 4 or 5 First Friday webinars, the average multiple is about 15 times, which expects earnings growth of around 6% per year. Clearly, the market is priced for growth of almost 10% a year during the next few years, and it's likely to be a hurdle that's way too far to clear. So our worry is that over the next few months, you'll start to hear the investing public begin to ask about growth expectations for the market. Remember now, the top 10 companies in the S&P 500 are responsible for 85% of the S&P 500's growth over the next year. That means the 490 companies of Standard & Poor's 500 are expected to grow almost nothing. So as as you know, what's going to happen is either we'll have a revaluation downward, or we're going to have several years of no return in the stock market, or meaning small fluctuations up, then small fluctuations or larger fluctuations down, eventually going nowhere for an extended period of time. Let me show you what the current pricing is, or how the let me say how this is the most leading indicator of bankruptcy filings, and we'll call these companies zombie companies. As you can see, the number of and the percentage relative to the indexes continues to march upward. This is really one of the most alarming slides I've seen. It shows that over 40% of the the Russell 2000 index is a zombie. That's clearly crazy. Here's the most recent aggregation we can find of actual bankruptcy filings as of early 2023. And as you can see, it's just getting started, and it's already sort of exceeding 2011 and 2012, which was among the most disruptive periods in our history. Here, I've taken a moment to show you what GMO, which is an excellent firm and forecasting company. Here you'll see their expectations based on current valuations for the stock market's returns for those counting on appreciation over the course of the next 7 years. As you can see, investors counting on growth in their assets based on public market valuations are likely to be very disappointed. I wanted to take a minute and show you why these earnings are likely to be disappointing, and why people that are counting on stock appreciation are likely to be equally well disappointed. This is a chart showing you the differences between, on the left-hand side, you'll see the rating of banks tightening lending standards or not lending at all. As you can see, this looks like a rocket ship increasing. And as you can see in the solid line, which is the table on the right-hand side, you'll see that the spread is starting to decrease. This is incredibly alarming. What it basically says is banks have stopped lending and consumers have stopped asking for loans. These are the canaries. The canaries are not dead. The canaries are still singing, but we believe that the long and variable lags of the Federal Reserve and their intent to slow our economy will slow our economy to the point of a recession. And during that recession, it will depend on what breaks. If something terrible breaks, we're going to have a very difficult recession. If something doesn't break and we get through this recession, we still have $32 to $33 trillion of debt to work off. I don't know, I can't figure the math out that allows us to get there without incredible growth, which is highly unlikely with our demographics and with the amount of debt we have. With that said, let me wish each of you a wonderful September and October, and we'll see you on the October First Friday meeting. Thanks.